Is there anything that stands out about the current market action over the last couple of days that tells you that maybe there's a direction either way, up or down, going forward?
Thanks, Dom. Thanks very much for having me. I mean, the key thing really is going to be differentiation. We're seeing this overnight already. Our expectation is that we'll continue to see this view of rebalancing or reallocating some of the risk away from the U.S. and to the rest of the world. We're seeing Asia outperforming because clearly the situation there when it comes to the virus is very different than the rest of the world. The same story going on with Europe, with actually a very different set of policies than those in the U.S. Again, we saw overnight a lot of uncertainty coming out from Secretary Mnuchin on the support coming through the Fed.
Rob, I wonder, we've been talking so much about this notion that markets continue to march towards and around record highs. For the fixed income markets, we haven't seen very much stress. Is it fair to say that the credit markets and the treasury markets are not as worried about what's going to happen in the future? What do yields tell you right now?
Well, thanks for having me this morning, Tom. I think it's clear that what the markets are saying is that in the medium term, growth is quite solid, and we expect that to be very supportive for markets. In the short term, we have a couple of policy issues where, first of all, monetary policy is in a sort of what we might call a policy pothole, in that we're not getting any additional monetary policy now. And secondly, of course, we know the fiscal policy we're in a bit of a battle about how much fiscal we'll get. So in the short term, we're going to get more volatility. But, in the medium term, I think the growth outlook and the policy outlook is pretty supportive for markets. And I think I would agree that it's time to start looking outside of the U.S., maybe more towards other non-U.S. countries, including emerging markets.
So, Rob, if I could follow up there, we just showed a graphic to viewers right now and listeners on SiriusXM. The 10-year Treasury note yield is currently just around 84 basis points, 0.84%. That doesn't scream at all to me like it's a growth kind of trajectory, a growth kind of profile for interest rates. Can you explain to us the disconnect there? What exactly gets yields moving higher, indicating some kind of degree of anticipated growth down the future?
Yeah, let me explain this, because I think this is very important. The Fed has essentially determined that the Fed will control the short end of the yield curve here and make sure there's very little volatility in the short end of the yield curve. And we've seen them be able to do that. They will not be able to control necessarily the long end of the yield curve, and including out to 30 years. So what we would expect is for them to be able to keep the short end of the curve very low, and indeed keep real rates negative where they are now, meaning that after inflation, you get back less from bonds, from government bonds. But in the long end, we would expect to steepen. And so rather than just looking at the level of 5-year, for instance, where the Fed can really trade, I would look at the steepness between 10s and 30s. And, we've started to see that steepen, which I think is telling us that the market is buying into the idea that growth is here, that growth will continue, even if we have some near-term headwinds.
All right, so Daniel, we interviewed Tom Lee over at Fundstrat yesterday. He was talking about this notion that he just raised his target for the S&P to 3,800. He's basically saying that large mega cap technology stocks will be kind of market perform for the rest of the year, but it's going to be some of those deep value kind of oriented sectors, the ones that have been beaten up during the pandemic, that'll lead the way higher. Is that what you're seeing? Do we think it's those beaten up type stocks in energy, in travel and leisure and hospitality that kind of lead the way higher into year end and into 2021?
Yeah. I actually, Dom, I would like to tie a little bit into the Treasury story, because that's really important. As we head into the recovery, there are so many different bottlenecks across the economy, right? I mean, you have entire sectors that right now are impaired and they need to start recovering. But as demand starts to catch up, the bottlenecks will start to surface and prices will start to rise. So pricing power will actually emerge from places that were unexpected before, right? And this ties in very nicely with the whole U.S. Treasury story and the steepening in the bond curve, because we're going to see the back end rising as those expectations increase. And also with it, some of the purchasing of the pricing power from those companies, particularly sectors that have been taking a hit over the past year. So this is really going to be very interesting heading into next year. I would expect the curve to steepen quite a bit particularly from the second quarter as the driving season begins here in the U.S.
Daniel, just a few moments left here. I'm going to give one last word to each of you guys. What's your favorite part of the market right now, Daniel?
I think the emerging market story will continue to outperform. This is an area where valuations are very attractive across currencies, across growth as well. So I'd expect emerging markets to continue to outperform over the next few months, yes.
And Rob, to you, your final word. What's your favorite part of the market?
Yeah, thank you. Daniel and I actually both agree. The flows to EM have been weak coming out of this COVID crisis. Now that the rates are so low in the U.S., credit spreads are quite tight in the U.S. and in the developed markets. We think it's time for emerging markets to have a bit of a run here.
Shepard Smith here. Thanks for watching CNBC on YouTube.